What's going on, y'all? Welcome to the premiere episode of the Hashing It Out live stream. I'm your host, Colin Harper, head of content and research at Luxor, coming at y'all from Nashville, Tennessee. It is August 29th, 2022. Beautiful day. Great day to go over some mining analytics. We're going to be talking about changes to hash price, given the recent downturn in Bitcoin's price. We're going to be talking about ASIC prices as well and what we're seeing in the market there as we're starting to see some stabilization. A few other mining metrics like the upcoming difficulty adjustment, and then we're going to wrap up with some news on the ETH merge and also on the latest Q2 financials from public mining stocks. So without further ado, let's just jump right into it, y'all. Alrighty, so like I was saying in the intro just then, Bitcoin's hash price, which for those of you who don't know is a metric that measures how much miners can expect to earn per unit of hash rate on a full pay-per-share mining pool like Luxor. We measure it in dollars per terahash per day or satoshis per terahash per day, depending on if you're looking at USD denominated or Bitcoin denominated. All that said, though, hash price has been waning recently as a result of Bitcoin's declining price and also a series of upwards difficulty adjustments that have really kind of squeezed it from both sides. So when difficulty goes up, hash price goes down, and if Bitcoin's price goes down, since hash price is tied, at least USD hash price is tied to Bitcoin's price, it will also decrease in value. So as you can see right here, we are back below 9 cents per terahash per day. Spot price right here says we're actually just at 9 cents, but this weekend we dipped below it to about 8.5 or just above 8.5 cents per terahash per day. Now, this came after a pretty, I wouldn't say uniquely profitable, but more profitable than we'd expect in a bear market period. We had a lot of hash rate coming offline as a result of multiple environmental factors, most notably heat waves around the world that took hash rate offline. Texas, for example, a lot of public miners like Argo, Corsair, and Riot had to power down and curtail as heat waves squeezed energy supplies in the region. When that was going on, we had a few downward difficulty adjustments that sent hash price back above 10 cents per terahash per day. We're going to take a look at the 3-month here. So as you can see, those difficulty adjustments coincided also with Bitcoin's price rising. So we saw some favorable hash price action, got to 10 cents per terahash per day and back up to 11 cents per terahash per day. But now it seems like the winds are not in our favor and it is now going back down. Now, obviously, this means that miners are making less money. It could mean that we see potentially hash rate getting squeezed and not growing as quickly as we think it would, as that's kind of been a theme for this year. A lot of people had some pretty high hash rate estimates for the end of the year. Saw 300 get thrown around a lot. For some more bullish cases, it was at 350. But, you know, we're about to enter September here. Only got 4 more months left in the year, and hash rate is only at 224 exahashes a second. Now, that being said, hash rate has grown a lot in the last month. It's kind of surged recently, really surged in the last week. We covered this on the hash rate index roundup this weekend. But last roundup, hash rate was at 211 exahashes a second on the 7-day average. And right now it is up to 225 to 226 exahashes a second. Pretty big jump. And unfortunately, that also means that our next difficulty adjustment is going to be an absolute whopper. Right now on hash rate index, we are estimating 9.49%. That's, you know, for those of you who know, obviously that is a nuclear adjustment that's going to really put a dent into hash price and put us back towards multi-year lows. Which is also all-time low territory. Hash price hit an all-time low of, since we've been tracking it, of about 7.5 cents, 7 cents back in Q4 of 2020. And looks like we're going to be reapproaching those prices unless Bitcoin's price does a huge U-turn. As you can see, with all of this hash rate coming online, block times are coming in at an average of 9 minutes and 8 seconds. The Bitcoin protocol tries to target 10 minutes. So basically coming in at a minute faster than average. That's why we're going to see, a difficulty adjustment somewhere in the ballpark of 8 to 10%. Probably that will hit on Wednesday of this week. And it's really, like I said, it's just going to continue putting a dent in hash price, like we've already seen, probably drop to 8 cents, maybe a little bit below it. And with that cheery note, let's go ahead and take a look at ASIC prices really quickly before we move on to the news segment. Yeah, as you can see here, 2022 has not been favorable to ASIC prices. If you follow our ASIC price updates on both the Hash Rate Index newsletter and also the ones we send out every Wednesday or Thursday, you'll see, obviously, you know this trend. It's just been turtles all the way down here. We have not had a single day or a single week this year where both new-gen ASICs, the red band here, and mid-gen ASICs, the orange band, had both had positive increases over the week. Thankfully, we're starting to see these prices stabilize a little bit. They're not dropping nearly as drastically week over week as they have been. I believe last week was one of the quieter weeks that we've had. But, you know, obviously Bitcoin mining is not nearly as profitable right now as it was compared to 2021. There's a lot of ASICs sitting in storage, waiting for power, waiting for rack space. So there's been just a general slowdown in deployment of hash rate this year. And as a result, ASICs have been hitting the market as miners look to shore up finances and get rid of inventory they can't support. Now, it seems that there's been a little more, agreement between buyers and sellers on what is a fair price here. As, like I said, prices have started to stabilize. That being said, there was some brilliant analysis in Galaxy Digital's latest research where they said if you want to ROI your machine in a year to a year and a half, I believe, an actual fair price given current hash price for ASIC prices would be about $20 per terahash for new gen equipment. So right now, as you can see from the ASIC index, it's at 34 at 20 cents dollars per or $34 per terahash and 20 cents. So if we really wanted to reach that $20 threshold, then we have a long way to go from here. Now, obviously, all of this can change on a dime depending on what Bitcoin does. But right now, as you can see from this chart, if we want to reach that fair price for ROI quicker, we're going to have to drop further from here. So keep an eye out for lower ASIC prices. We're personally of the mindset that they have farther to fall still. But obviously, all of this could change if Bitcoin's price starts ripping from here, which also doesn't seem likely given the macro environment, given Fed interest rates and general quantitative tightening from the Fed and the dollar strengthening. So check out this page if you haven't already, data.hashrateindex.com/ASIC index data. We update this every week to give you the most recent market prices from all of the data sources that we scrape. And every month we also update the average monthly price for popular rigs, S19, S17, S9, M30, M20, all that good stuff. Great resource, only thing like it on the web. And if you haven't already subscribed to our newsletter on our blog, and like I said, we give weekly updates on both hash price and ASIC prices in our weekly weekend newsletter. So with all of that said, let's go ahead and move on to the first item on our news segment, which thing that's on the top of a lot of people's mind in the crypto sphere these days is Ethereum 2.0 launching. Ethereum is moving to a new consensus mechanism, proof of stake. This has been a move that has been on the docket for Ethereum since it launched in 2016 and was being designed in 2015. And for a newsletter a few weeks back during the weekday, I wrote about what are Ethereum miners going to do after proof of stake Ethereum launches. Obviously, we've gotten this question a lot. We run an Ethereum mining pool. A lot of people thought we were crazy for launching the mining pool last year when Ethereum 2.0 was on the horizon. And now people are asking us, well, what's going to happen when Ethereum 2.0 launches? And so far, there have been about really two proposals on the table besides Luxor's position, which we are advocating for Ethereum to remain proof of work because we believe it is the most tried and true consensus mechanism and the most secure. But failing Ethereum staying proof of work, and if the Ethereum merge to Ethereum 2.0 is successful, then there are more or less two camps right now that have been represented in the Ethereum mining community. One of these camps from a mostly Chinese constituent of Ethereum miners is to fork Ethereum and keep it proof of work. So in the same way that we've seen Ethereum Classic fork from Ethereum after the DAO hack in 2016, and in the same way that we've seen other blockchain forks like Bitcoin Cash, things like that, this contingent would fork Ethereum and keep the proof of work consensus mechanism intact. That is one proposal on the table. And the other more obvious proposal is switch to another altcoin, right? Like Ethereum Classic, which would be a trivial change for Ethereum miners, or something else like maybe Dogecoin or Ravencoin or something like that. Now, in this article, I cover the practicalities of both of these things and a little game theory that would go into either or of these options. I don't want to spend too much time on it today because there's a lot of ground to cover with this. There's a lot of reading material, and there's been a lot written about and spoken about on podcasts about what could happen and what would happen if these things came to pass. But we're going to go over them just briefly here today, starting with the ETH proof of work fork. Now, the ETH proof of work fork has been proposed, like I said, by a contingent of Chinese miners. Their ringleader, it seems to see, or at least the frontman for the operation, is a guy named Chandler Guo. He helped fork ETH Classic back in the day, and now he is back for round 2 by forking Ethereum. He said in a tweet on July 27th, "I fork Ethereum once, I fork again." Of course, like with Ethereum Classic, he's not acting alone. There have been chats on Telegram and on WeChat that have been circulating these plans for a while, and they've also been coming out with a lot of technical developments, such as launching a testnet, launching a GitHub with the code. And one of the developments that has caught Ethereum miners' eyes, and which has been, pretty controversial, given the fact that it makes this whole thing look a lot more centralized than the organizers probably would like, is that instead of just getting rid of EIP 1559 entirely, which they say they're going to do, they're actually going to replace it with something else. Now, 1559 was an Ethereum improvement proposal that took Ethereum transaction fees and burned them instead of granting them to miners for a number of reasons that we won't get into right now. But 1559 really kind of spurred forth a lot of developments in miner or maximal extracted value on the Ethereum ecosystem, which is another way for miners to make money by basically identifying profitable trading opportunities and organizing blocks in such a way that they can capitalize on those trading opportunities. Well, instead of just getting rid of 1559 and returning fees to the miners, this fork is saying that the fees will then be collected into a treasury, a multi-signature treasury that is managed by, they say miners, and they say people who are, loyal to this fork. I asked them on one of their Telegram chats who would actually hold the keys, and they could not give me a straight answer. They couldn't give me names or any associations or anything like that. And all of that to say, that will be a huge deal breaker for a lot of miners. It was already hard to trust this fork in the first place for a number of reasons, and once they came out with this, it's really hard to imagine that many miners will actually go along with it because they can't trust that they'll actually receive revenues from fees, right? If it goes into the multi-signature address, how can they actually be sure that they're going to be able to extract those fees in the future? Who holds the key to it? Kind of just seems like a big boondoggle, right? So that's one, I would say, red flag that is going to keep a lot of Ethereum miners, at least those who aren't on the inside of this, from taking it seriously. And, the other red flag, or not even red flag, just kind of practicality, is there's not really any indication that this fork will actually gain enough economic value or get enough, traction behind it to where it will actually have enough value for the miners to recoup their electricity and hardware costs, right? Now, that being said, there are already some exchanges like BitMEX and Poloniex, among others, who have listed basically what are perpetual swaps for this asset on their webs or on their trading desks. So you can actually go and trade this coin right now. You can long or short it on these platforms based on whether or not you think it's going to accrue in value or just absolutely blow up. But who knows as to whether or not they'll actually list the spot asset when it comes out. Now, they probably will. They have an economic incentive to do so. And there's money to be made here, right? Like, when have you ever known an exchange to not list a fork and cash in on the revenue from it? But that's not the only thing, obviously, that would give this chain value. The real reason why Ethereum has been so lucrative to mine in the last bull market, which, by the way, for those that don't know, was actually more lucrative to mine than Bitcoin itself. The reason being is all of the DeFi applications that are built on Ethereum. Now, if you cannot replicate these DeFi applications onto the proof of work Ethereum fork, you do not have the same level of transaction fees, and you also do not have really just the same base chain value. You know, part of the reason why Ethereum grew in value so much in the last bull market is people were buying it to pay for gas to use these DeFi applications. Now, there are currently no indications that there will be DeFi application replicas on the ETH proof of work fork. In fact, we have a little bit of the opposite. Chainlink, the most popular decentralized oracle on Ethereum, has said that they will not support the proof of work fork. And likewise, stablecoin issuer Circle and Tether have said that they will not redeem stablecoins on the proof of work fork. Now that is big, because if you can't actually replicate those stablecoins, then who's going to actually use any DeFi applications that come up on this fork, right? Stablecoins have been a huge anchor for a lot of DeFi protocols. It's where a vast majority of a lot of the trading volume comes through some of these trading protocols. MakerDAO, for instance, which launched one of the first, the first decentralized asset-backed stablecoin on Ethereum, is largely capitalized by USDC at this point, right? So unless you get those stablecoins on this new Ethereum proof of work fork, it's hard to imagine that anyone will actually use it for trading or even use it to execute DeFi trades, things on, things like Uniswap and things like that. And of course, obviously, we're getting ahead of our skis here a little bit, because we don't even have any indication that someone will fork something like Uniswap or Curve or Compound Finance and create a replica of it on the Ethereum proof of work blockchain. Now, if you have the technical prowess and run an Ethereum full node, you can access all of these decentralized applications on ETH proof of work by speaking directly to the Ethereum protocol, right? But for most of us who do not run an Ethereum full node and who do not have that technical prowess, we would need a front end to actually interact with these applications, right? And so far, no one has come forth and said that they would actually build those things. So all of that being said, hard to imagine this Ethereum proof of work fork actually gaining enough economic weight to be worth mining. And kind of case in point, if we look at some of the ETH proof of work futures on BitMEX and Poloniex, I mean, this thing has just been driven into the dirt since it was first listed I think it was the beginning of August, maybe. I think that they listed these. This is BitMEX's trading book for ETH proof of work. And look at this volume. I mean, it's just, there's nothing going on there, right? And kind of same with Poloniex. It's just kind of been driven down since it was listed. And Poloniex's 24-hour volume is only $312,000. Most of that is also probably spoofed. So very few people are really showing interest in this right now. So it's really hard to believe that any of this will actually gain any significant economic weight. But could be wrong. We'll just have to wait and see. The fork will probably come shortly before or during the merge. And the merge is so far tentatively scheduled for September 15th and 16th. So all of that to say, we will see what happens there. Now, moving on to Ethereum Classic and other proof of work altcoin options. The long story short here, and why we're going to be spending less time on this, is it's just less complicated. The ETH proof of work thing, there's a lot to unpack there. With here, the choice is pretty simple, right? ETH going proof of stake, just move to ETH Classic or Ravencoin or something else that is GPU friendly to mine, right? The problem here is kind of like with ETH proof of work, where you can't really expect the same amount of revenues. Ethereum Classic just does not have the economic value that the Ethereum chain has. As you can see, year over year mining rewards from August 15th, 2021 to August 15th, 2022, Ethereum generated $15.7 billion worth of mining revenue. Ethereum Classic, 277 million. That is a huge gulf. And looking at Dogecoin, which only generated $792 million worth of revenue because of, investor fervor and guys like Elon Musk tweeting about it, saying it's going to go to the moon, it only generated just shy of 800 million in probably its most prolific bull market to date. Now, we can't really trust that Dogecoin is going to, produce similar returns, especially in a bear market. And looking at other options like Monero, only 39.8 million last year, or year to date. And I don't have Raven coins, but it would not be. It would probably fall somewhere around Monero, but Coinmetrics didn't have data on that, so I couldn't pull it. Also, just for note, Litecoin is mainly mined with ASICs. You couldn't really hope to mine it with GPUs, and we're kind of just putting it here for comparative purposes. But all of that to say, if miners want to go to Ethereum Classic or another altcoin, there's not really too many places for them to go because cumulatively, Ethereum Classic, Dogecoin, and Monero, those only have, $1.1 billion in revenue collectively year to date for this time frame. So all of that to say, there are not many two options for Ethereum miners, and it's going to be pretty tough for most of them to turn a profit once this thing is over. And with all of that said, I wanted to spend a little more time talking about censorship troubles on, talks of censorship resistance for Ethereum 2.0. And when it goes to proof of stake, I'm starting to think that maybe that's out of the scope of this live stream. We're kind of running shy on time. But the TLDR is after Tornado Cash launched, or after Tornado Cash was sanctioned by United States OFAC, Office of Foreign Asset Controls, it kind of ignited this flurry of discussion over what happens when Ethereum goes proof of stake. As we can see here, Flashbots is planning on making their maximal extracted value programs or private mempools totally OFAC compliant. They were already starting to do this, and when Ethereum goes proof of stake, we're going to see the same thing. Now, the reason this is such this isn't a bunch of Ethereum transactions just can't get processed because none of the centralized staking providers are willing to actually take the risk and put them in their blocks. Again, that's kind of the shallow take on it. There's a lot more to unpack here. Eric Wall has written a pretty good blog post on what to do to keep this from happening, and it basically involves a scenario where you slash the Ethereum staked up in these providers. So if a validator acts in a way that the network feels is unjust, then you can basically take their staked ether and burn it. This is a really complex issue. It also would involve a lot of collateral damage because, for instance, like we said, these staking providers are centralized and they're staking on behalf of their users. So when you're slashing Coinbase and Kraken, you're also slashing all of the people who have staked their ether in Kraken or Coinbase, right? But I would recommend checking out this article if you want to learn a little bit more about this. It's very complex, but Eric seems to think that there's a way out of this to where we don't have to have an OFAC compliant chain. Basically using a kind of user-activated soft fork type mentality like we saw with Bitcoin during the block size wars. Recommend checking it out. We are not convinced. We think that proof of stake is going to open up massive potential for censorship and for potentially state capture of the Ethereum blockchain, which is why we would like to see it stay proof of work. Now, with all of that said, we will cap off today's discussion briefly with some rundowns of public Bitcoin mining stock financials from Q2. Now, it was a brutal quarter, obviously, as any miner knows. Last year, average hash price was about 30 cents per terahash per day, and over the course of Q2, it crashed to a low of like 7.25 cents per terahash per day. So massive decline in value, over 60%. Mining economics crashing by 60% in that time frame. And as a result, some Bitcoin mining, public Bitcoin miners are really starting to feel the heat. A lot of them printed substantial losses in Q2, obviously because the price of Bitcoin plummeted over the quarter by 58%, which is what a lot of these miners hold in their treasury as a cash equivalent. Additionally, Bitcoin mining ASICs, their main productive asset, they fell across the board by 47%. New gen ASICs fell by 47%. Old and mid gen fell by even more. So these miners are basically posting serious material losses on things like that, right? Now, those losses are not realized, obviously, but the value of their treasuries and also the value of their inventories for mining just obliterated over the course of the quarter. Now, that being said, looking at April to June Bitcoin mining production and also April to June hash rate growth, few miners actually had positive growth over this quarter. A lot of them had trouble deploying hash rate, had trouble keeping hash rate online for a number of reasons, including, like I said at the beginning, the Texas heat waves. And as a result, Bitcoin production and hash rate growth was impaired across the board for the quarter. As we can see here, we can see some of that impairment in the Bitcoin mined per exahash for Q2. Miners like Argo and Core Scientific and Riot, for instance, who operate largely in Texas, or a lot of their hash rate is in Texas, they had decreased revenues, and so they mined fewer Bitcoin over the quarter per exahash. Now, this revenue was supplanted in some ways with certain things like power credits, right? As Riot pointed out, they, I think it was in July, they earned like $9.5 million worth of curtailing credits. Over the course of Q2, I think from their 10Q, they said that they earned somewhere between 5 and 6 million in power credits. Argo and Core Scientific did not mention anything like that, but as you can see, there are ways for them to recoup those losses if they are selling power back to the grid. Other miners like Marathon had issues with their mining site in Hardin. They claimed storm damage took a lot of their capacity offline. They're actually they have liquidated that facility, and they're moving and going to Texas to host at Compute North. Other miners had more favorable go of it. As you can see, Iris, Greenidge, Hut 8, and Bitfarms had pretty high Bitcoin mined per exahash, as did Hive. And now a little caveat here, Hive and Hut 8 liquidate all of their Ethereum mining output into Bitcoin, and that goes into their total Bitcoin production for the quarter, which is part of the reason why they have such high numbers there. A big theme for this quarter was Bitcoin miners selling Bitcoin to pay debt and fund operations. You know, a lot of these miners hoarded Bitcoin in the bull market only to sell it when it was discounted heavily in Q2. As you can see, they sold collectively more Bitcoin than they mined. Out of the miners that we surveyed in this report, they collectively sold 18,000 Bitcoin and they mined 10.7 thousand Bitcoin. So pretty big delta there. It seems like for now they might have sold as much as they need to, at least in the heavier liquidations. That being said, would not be surprised if for production updates going forward, we see miners selling more Bitcoin per month than they were accustomed to in the bull market as they are looking to fund operations because economics are down. It's harder for them to finance and take out debt to fund operations. We're actually starting to see equity raises become more favorable to these miners in the bear market because access to capital is becoming even scarcer. And as you can see, building on that selling news, we can see Bitcoin mining treasuries decline over the course of the quarter. Core Scientific taking the biggest hit, Bitfarms taking the second biggest hit, and so on. And there are a few more metrics that we cover in this article. We're running out of time, so I would just recommend you check out the article. It's on our blog. We've got some of our some metrics that we pioneered here, such as the enterprise value and ASIC value metric. And we also take a look at enterprise value and revenue ratios for these miners. You can see this chart here, really a mixed bag over the course of the quarter. We wanted to do enterprise value and EBITDA, but so many EBITDAs over this quarter were negative that it just kind of muddied the analysis, so we just stuck with revenue for this quarter. Hopefully next quarter it'll be some brighter and sunnier reporting so that we can get that EBITDA metric in there as well. And we also cap off this this newsletter with some news and operational updates that followed Q2. Like I said, you can see here HUD 8 doing an at-the-market offering for up to $200 million, and Core Scientific doing something similar, doing an equity offering in a bid to fundraise. Like I said, that's going to be probably the primary vehicle for miners to raise funds during this bear market as access to capital becomes more difficult. And with that, y'all, we are finished with the first episode of this live stream. We are going to be doing this every Monday at the same time, 11 a.m. Central Daylight Time, and then Central Standard Time when that kicks in. So we really appreciate y'all tuning in. And if you don't already, please throw us a follow on Hashrate Index and on Luxor's Twitter. And also, if you haven't, please subscribe to the Hashrate Index newsletter to get weekday and weekend updates on Bitcoin mining news and market movements, economics, hash price, ASIC prices, the whole enchilada. Thanks for tuning in, y'all. Really appreciate it. Have a beautiful week and happy hashing.